Okay, so the chapter we are going to talk about today is financial information and stakeholders. So in this chapter, we are going to talk about what type of financial information we produce, right? And what are stakeholders and what are their requirements, particularly related to the financial information. Okay, so let's quickly dig into it. Okay, the purpose of financial statements. Mm, Financial statements, we basically produce the financial statements, um, like we have statement of financial position, we have statement of profit and loss, statement of other comprehensive income, statement of changes in equity, statement of cash flows. Okay, so this is basically the set of financial information, the financial statements that every company needs to make. It depends whether um, the type of the organization. If it's sole trader, so it is not mandatory for them to produce financial statements. Uh, Even for the partnerships, it's not mandatory. But for the companies which are registered, like private limited companies and public limited companies, they have to publish their financial statements. For the public limited companies, because public is investing in those companies, right? From the perspective of, um, all of these companies are registered on a stock exchange, and general public can invest in those companies. So interest of government is involved. So there is a lot of regulation on public limited companies to produce their financial statements. Anyway, so statement of financial position, it analyzes your assets and liabilities primarily. Yeah. Statement of profit and loss, it actually look at whether you're making profit or you're making loss, yeah, as a company, right? We have the statement of other comprehensive income. So other comprehensive income is basically connected with the statement of profit and loss, but in statement of other comprehensive income, you are reporting the income which you have earned, but you have not yet realized. Like for example, if you have revaluation gain, so revaluation gain is some revaluation gain on an asset. So it's like, your asset was booked at 10,000. Now you revalued your asset to 15,000. So that's a gain of 5,000. This is the gain of 5,000, but you have not yet realized this gain. When you're going to realize this gain? When you'll dispose of your asset. So when you dispose of your asset, you will be realizing that gain. So this is the type of information that you want to give to your shareholders, but you want your shareholders to know that this is the gain you have realized, this is the gain you have earned, uh, but because you have not yet realized it, so you cannot make it part of the statement of profit and loss. So, you have another statement for that, which is statement of other comprehensive income. Okay, so in statement of other comprehensive income, you have stuff like revaluation gain and any other unrealized profit, right? So you would book it in your other comprehensive income. Then you have statement of changes in equity. Okay, statement of changes in equity actually look at the movement um, in your equity. Right. Okay. I'm just looking at the white space. Just give me a second. Okay, so the capital or um, equity part of your balance sheet looks like this. I'm talking about the balance sheet, okay? Share capital, share premium, retained earnings, revaluation reserve, okay? And if you have any other reserve, okay? So we add all of these figures together, right? And it becomes part of your uh, equity in your balance sheet. In the statement of changes in equity, you actually try to understand the movement between each head. Okay? So you just, the statement of changes in equity looks like this. Share capital, share premium, retained earnings, revaluation reserves, other reserves, right? No. And you start with an opening balance of each head. And during the year, if there are any changes, so you would just make those changes. If there is any addition or subtraction, right? And you get the closing balance of each head. Okay? By the way, this is the closing balance which you have in your balance sheet here. Okay, so statement of changes in equity looks at the movement um, in your equity, right? For example, if you issued shares, right? So if the company issued shares, so they are going to have addition in their share capital and their share premium if the shares are issued on a premium. So you would show the addition in share capital and share premium. Okay. If you made a revaluation reserve, so you would show that in your statement of changes in equity, right? If any, if you move the funds from retained earnings to other reserves, okay? So you would subtract from retained earnings and add in other reserves, okay? So, the fact of the matter is that in statement of changes in equity, you are actually showing the movement in in the equity portion of balance sheet. Okay. So this is your statement of changes in equity. Then we have statement of cash flows. The statement of cash flows is simply the movement in your cash flow, right? I hope you guys are familiar with the format of statement of cash flows. You have operating activities, financing activities, and investing activities, right? So you show um, the in and out of cash in the statement of cash flows, so you know that how much cash the company got this year and how much cash went out of the company. This is statement of cash flows. Okay. All right. So we have a question here. Do you guys want to try it? You can give your answers in the chat. Yeah. Yeah. Yes. Yes. The comprehensive income. Yeah. Statement of changes in equity. Number four is statement changes in equity. And fifth is cash flows. Cool. Yeah, you're right, Kate. Perfect. Okay. We have a concept of stewardship. So stewardship is basically refers to the accountability. So, the problem is sometimes we refer it to the agency problem as well, that directors are running the company. Sometimes we call it management as well. So director or management, it is responsible for running the company. And the company is owned by shareholders. And you have other stakeholders as well who are entrusted in the affairs of the company. Like, for example, mm, government is entrusted, employees are interested, um, the tax authorities, obviously, suppliers are interested, customers are sometimes also interested. So, um, stewardship refers to the accountability of management for the resources entrusted to them by the owners or government. Okay. So owners has given the control of resources to the directors, because directors are the one who are running the company. So they have the the ownership for the time being, ownership of the company because they are running it. So stewardship is basically the concept that directors or management is accountable for the resources which are given to them. They're accountable for that. Okay, so this is stewardship. The needs of users. So we have users of financial statements, right? Different stakeholders. So stakeholder is a person who can influence by the business, or who can be influenced by the business. Okay, so it's a stakeholder. That's a definition of stakeholder. So stakeholder, you have different types of stakeholders, and they have got different needs. Like, um, you have shareholders and potential investors. The existing shareholders of the company are interested in the affairs of the company because they have invested their money, right? So one, they want to see that where their money is going, right? Whether the company is going good or bad. Two, uh, if the company is not performing well, so they would pull out their funds and they would invest somewhere else. Okay? Or potential investors, the persons who are looking for investing in the company. So potential investors are also stakeholders and users of the financial statements, and they are interested in that as well, in the affairs of the company, right? So they need to have a look at the financial position of the company, that what is the position of assets and liabilities of the company, how much profit company is making, what is the position of the cash flows, right? So they would be looking at all of that stuff, um, to make the decision, right? They have to they need that information for decision making. Management. Management use the financial information to assess the performance of the company, that how the company is going so far, and they also use that information to make decisions, right? So they have to make let's say if management is considering investing in a new venture, so they would definitely have a look at the balance sheet and see how much cash they have, right? They will look at the cash flows and see how much cash is coming from operations. So what is the sustained cash flow of the company? Right? They would be looking at their liabilities and everything. So to have the decision making, to for decision making, management needs the financial information. So management is another user of the financial statements. Employees and trade unions, so employees are definitely interested how their company is going, right? So especially, the senior management and the senior level staff, they are interested in how the company is going because they have to make a decision whether they want to be with the company or whether they want to leave the company, right? So employees and trade unions is basically that's more um, related with the manufacturing businesses. So in a manufacturing business, you have labor, right? So labor is represented by trade unions. Um, these trade unions represent uh, the the um, the seniors in the trade union would be looking at the financial position of the company, financial performance of the company, and everything to make their decisions. Customers are also interested that um, that's more related with B2B businesses, right? So B2B businesses, business to business. Like if a business is providing machinery to another business, so that's a B2B type of business. In a B2B type of business, you let's say if you're ordering a machinery from the company and the machinery would be delivered after like 6 months, okay? So you are going to wait for 6 months to get your machinery, and that's going to be a big amount of money. So there is a risk involved. If that company goes bankrupt, so probably as a customer you would lose your money, or probably you're going to have the delays because you won't be getting your machinery and everything, right? So you really, as a customer, want to see the performance of the company so far. So you will be looking at the financial performance, financial position, and everything to assess whether the company is doing good or not. Okay. Suppliers are very concerned because they are giving you credit. Right? This is normal in market that you will be given a credit of like 45 days or 60 days, right? So if the supplier is giving credit to the company, so they would be interested in the financial numbers. Okay. Lenders, the banks is one example of lenders. So banks are very much interested in your statement of financial position, statement of financial performance, cash flows, and everything, right? HMRC and about HMRC, that's basically an a government regulatory body which collects tax, right? So they are also interested. Okay, public. Generally, the public would be interested in the profitability of a company to see the impact of that company on the society as a whole. Like, generally people would be interested that how much profit Apple is making, right? They are not investing in Apple, they are not working at Apple, but they would be interested in how much profit they're making, how much cash the company has, right? So general public is sometimes interested as well. You would just keep on seeing on social media uh, news like how much Elon Musk has made, how much Apple lost. So general public is also interested in big companies. The Jeff Bezos is the richest person now, but now he's not. So yeah. Okay. So For the companies which are registered with uh, stock exchange, where the Security and Exchange Commissions, where um, the shares can be traded among general public. Like I said, when general public is involved, it is the responsibility of the government to take care of the rights and of the general public, right? So the government, to protect general public from fraud or some financial loss, there is strict regulations on registered companies who are trading on a stock exchange. So UK, we have some legal requirements. So if you have, the one of the legal requirements is UK law, right? Um, the most of the stuff is being driven by this Companies Act 2006. It provides guidance on the format and the content of financial statements, right? So what's going to be the fundamental accounting principles, etc. So a lot of information related to financial statements is coming from Companies Act 2006. Then we have accounting standards. So we have these accounting standards. We have two types of accounting standard. One is each country have got their own accounting standards. Like UK has got their own accounting standards. Um, US has their own accounting standards. And then there is an international body with the name of IASB, International Accounting Standard Board, which is trying to um, do the convergence. Convergence is that they are trying to make the standards for the whole world similar, like everything else. Like, 1 kg in Europe would be same as 1 kg in US. 1 meter is similar to 1 meter in different parts of the world. So because they are standards, okay? Like if you guys have studied physics, so there are so many units like newtons for force, um, and yeah. So this is how the IASB board, International Accounting Standard Board, is trying to bring convergence between the generally accepted accounting principles of countries and the standards they are issuing. So what they're doing, one by one, they are revising the standards, keeping different accounting bodies of different countries on board and bringing new accounting standards, which we call IFRS, right? International Financial Reporting Standards, right? So, so yeah. So, each company, either they would be following UK um, accounting standards, which are known as GAAP, generally accepted accounting principles, or they would be following IFRS. Okay. So it depends on the company, what they're doing. Normally, company goes with the IFRS. And there is, to be honest, there is not a lot of difference between these standards. Okay. We talked about the financial accounting. In financial accounting, our goal is to record, analyze, and report. Record means we record all the transactions, then we analyze them in the form of financial statements, then we report it by publishing it, right? Either we can publish it on website or we can actually get the printouts and get it distributed. So these three things are part of financial accounting: recording, analyzing, reporting. Recording, you're recording the transactions. Analyzing, you are converting that data in a more readable form, like income statement, the statement of financial position, statement of financial performance, cash flow, equity, right? So yeah. So this is what you are doing in financial accounting. In management accounting is more concerned with helping the management running the company. Management need information to run the company. Like they, if they, let's say a company is in the process of launching a new product, they have to set the price of that product. If they know the cost of the product, then they would be able to set the price, right? So costing is in itself um, is a comprehensive process. Like you must have studied, or probably you'll study in AMAC. So this is and so the stuff like costing, budgeting, variances, performance analysis, stuff like that. So that is more concerned with um, the management accounting. Okay? You're making the budget reports, variance reports. So the major difference between financial accounting and management accounting is the management accounting, the purpose of financial accounting is to make reports for external users, like shareholders, like investors, like government, HMRC, um, employees, etc., etc. So this is basically suppliers, customers. So you are making the financial statements primarily for the use of external stakeholders, while management accounting is more concerned with the with making reports which are used in by the internal stakeholders like management, right, in decision making and everything. Okay. All right. So when you get a management report, you have to see that whether the report is a good report, whether you should be relying on that report or not. Okay. So that would involve a small process like basis of preparation, like on which basis. Okay, so one more thing about management accounting is, like we have studied in financial accounting, when you're making the reports, you have set formats. Either you're following IFRS or you're following the country's accounting standards. In both the cases, you are following a set pattern. In management accounting, you don't have a set pattern, right? So it is more on the discretion of the accountant that how he wants to make that report. Okay, so when there is no set pattern or there is no um, standards, so basis of preparation is more important. On what basis that um, report is made, then what methods they have used, right? And what figures they have used. Like, for example, if you are forecasting 5-year sales of a company, so which figures you're using? Is it, I mean, are those figures reliable? So that's a big question. Okay. And what's going to be the impact on people from those management reports? Okay, so let's say you get a budget, right? You get a budget in front of you. So the first question you ask, that on what basis that budget is made? Okay, what methods they have used? Like, there is a lot of variables when you're making the management reports. Like, uh, are you taking the inflation into account? Like, for example, if you're making a 5 years budget, so how much inflation you're taking into account, right? um, what about the value for money, right? What about the interest rates by the government, right? So what variables you're using? So probably, you would ask these type of questions before relying on a management report. Yeah. Okay. Stakeholders, we have internal and external stakeholders. Internal stakeholders, yeah. Okay. Okay. All right. Okay. Please try this question. Yes. Internal. No, this is not part two is okay. All right. You can think more. Okay. All right. So you can try all of them and then, we discuss the answer. Yeah, third is management. Okay, so for two, the better answer would be financial. Okay? The first answer is correct. The management accounting is critical function that provides detailed financial and non-financial information primarily for management or internal use. Okay. This type of accounting focuses on financial processes because it is working with the numbers, right? Processes and supports decision making within the organization by delivering relevant and timely data to management. That's correct. Okay. Then we have the information produced by management accounting is utilized by, again, because this is only used by the managers. So the option would be again management. Okay. So the information produced by management accounting is utilized by management to assess various aspects of the business, including dash. Okay. What should be uh, gap 5? Yes. This is, yes, you're right, budgeting. This assessment allows management to make informed decisions related to dash, dash, and dash. So, what we can do is in gap 5, we can write the organizational performance, okay? Because here we write organizational performance and related to budgeting, planning, controlling, and budgeting allocation or resource allocation. Okay. Let me write that down. The information produced by management accounting is utilized by can management. There's various aspects of the business, including, I'd say, organizational performance. This assessment allows management to make informed decisions related to planning, controlling, and resource allocation. Okay, any confusion? All right. So this is again part of your curriculum. You have to understand um, between the financial information, what type of financial information is required in an organization, like in the management reports and everything, right? So we talked about that, and then we talked about stakeholders. Do you guys have any question? All right. Now, let's move on to our third chapter, which is internal control systems. We talked about the internal control system yesterday as well, and we talked about some basics related to internal control systems, right? So, internal control system, just give me a second. Internal control system again is, let's say if we draw an office and we try to see that how many types of internal control systems we have. So on the entrance, you have thumb impression, right? Or probably, you would be scanning your card to enter the office. That's an internal control. Internal control is something which we install to prevent fraud and error. Okay. So we don't want unauthorized entry in the office. So we installed this system so that only the authorized can enter the office. Okay. You walk into the office. Let's say this is your desk, and this is where your manager is sitting. Okay. So your manager is part of internal control system because he or she is keeping an eye on you. So that's again a part of internal control system. Okay. And then, you make a report, right? And then you submit it to your manager, right? So the manager is supervising you on your work. That's part of the internal control system. Okay. Um, so that's how the internal control system works. Okay. You have the quality assurance department, some of the members of the HR are keeping log of the entry and exit of employees. That's part of internal control system. The finance department has got many internal control systems as well. They are basically a check on the whole organization because numbers tell everything. So you're getting a lot of information um, from just looking at the numbers, right? So that's part of internal control system as well. Okay, so let's try to have a detailed understanding of internal control systems. Okay, internal control system is a process designed and implemented by those charged with governance. You would hear this, you would read this line often during your preparation. So we have to understand the what is those charged with governance. So governance, that's basically your board of governance, right? Board of governance is a very effective part of the internal control system of any organization. Like if you're familiar with, so on a board of a company, you have got directors sitting on the board. Okay? So these directors, you have got a complete code for what should be the structure of that board of directors, right? For example, you know, we have executive directors and we have non-executive directors. Executive directors are the ones who are involved in day-to-day operations of the company. Like your marketing director is your executive director. Your finance director is your executive director. On the other hand, non-executive directors are the ones who has nothing to do with the day-to-day operations of the company, and they are just sitting on the board reviewing the performance of executive directors. Okay. So executive directors are basically from management, and non-executive directors are representing your shareholders. Non-executive directors are representing shareholders, and they are keeping an eye on the performance of executive directors. Okay, so we have got the uh, instructions that how should the board of directors of the company should be made. At least, the executive directors and non-executive directors must be equal in numbers on the board of the company. Then, the chairman of the board, the one who chairs all the meetings, is also a non-executive directors. Then we have different committees within the board of directors, like we have remuneration committee. Remuneration committee is which decides the salaries of all the directors. Okay? Directors themselves cannot decide their salaries, so there would be a committee which we call remuneration committee, and that would be primarily comprised of non-executive directors, and they would be deciding the remuneration of the directors. In the same way, we have audit committee. So audit committee is responsible for liaising with internal and external auditors. Like imagine a situation in which the CEO is hiring the the external auditors, right? So CEO is definitely going to hire um, an organization which is the audit company, which is not which is like biased towards that CEO. That's why we have audit committee, which consists of only non-executive directors. There would be probably one executive director sitting on that committee to help them, but mostly it is a non-executive director committee. All right. So audit committee we talked about, remuneration committee, and then we have a couple of more committees like risk assessment committee, right? So that would be just assessing the risk associated with the business, right? So the board of directors, this is basically known as those charged with governance. Those charged with governance, whenever we say that, these are basically the persons who are responsible for governing the company, right? So they would be responsible for the internal control of the company as well, right? So they are the ones who, because they are liaising with the internal auditors as well, so they are responsible for the internal control systems within a company. Okay, all right, let's get back to that. So internal control is a process designed and implemented by those charged with governance and then management and other personnel. Okay, so you design the internal control system and implement it. Okay? So it provides reasonable assurance regarding the achievement of objectives in three main areas. Okay, let's try to understand this word as well. You're going to hear it a lot as well. Reasonable assurance. Because you cannot give 100% assurance about anything. Um, like, for example, if there is a company which has a top line of $1 million, so you cannot 100% say that there is no fraud or error for even a single dollar. You cannot say that. So you cannot provide 100% assurance. That's why we use the word of reasonable assurance. Okay. So internal control system provides reasonable assurance regarding the achievement of objective in three main areas. reliability of financial reporting. Whatever the financial reports you're making in like statement of financial position, statement of financial performance, cash flow, changes in equity, other comprehensive income. So good internal control system represent that these financial statements can be relied upon. When external auditors go to a company, the first thing what they do, they check the internal control system of that company. How effective the internal control system is. If internal control system is effective, they would be relying on the information given to them by the management, right? If internal control system is not effective, so they would be doing all the testing themselves, like the operational testing, which we call the substantive testing. Okay, so internal control system ensures the reliability of financial reporting. Then effectiveness and efficiency of operations. Okay? So if you have good internal control systems, it means you have less errors and frauds, which means your company is working effectively and it is working with efficiency. Okay. It also represents the compliance with applicable laws and regulations. Like if the internal control system are working, it means you are complying with the regulations and laws as well. Okay. All right. So these are basically this is what internal control system provides to a company. Okay. Then we have components of internal control system. So we have like control environment, we have risk assessment process, we have information system, and we have control activities, we have monitoring of controls. So all of those things, they add up together to make the internal control systems. That's why we call them components of internal control system. Okay, so control environment. Control environment is like, yesterday I was giving an example of the Japanese car manufacturers like Toyota and Honda. So what they did, they actually embedded the quality assurance within the employees, right? They actually trained all the employees to make sure that everyone is taking care of the quality. Okay, so you are creating an environment in which internal control systems are considered important, right? I mean, if the culture is that CEO of the company comes 1 hour late every day, so definitely you're going to have the culture of coming late to the company, right? Everyone would start doing that. If mostly no one is following uh, the regulations or procedures, it means uh, you don't have the culture or you don't have the environment. How can you create the environment of internal control in your organization? You can do it by training your employees, by making sure that all employees knows the importance of internal control systems and everything, right? So the key elements of internal control environment is integrity and ethical values, okay? Commitment to competence, ethical values. You guys must have heard about it a lot. So integrity, objectivity, confidentiality, all of those ethical values, professional behavior, due diligence, right? So how much importance is given in an organization about all of that stuff? That's one of the key element of control environment. And commitment to competence, how much committed you are to deliver your job with competence, right? Participation of those charged with governance. Those charged with governance is basically your board of directors. Okay? How much they are participating within the company, right? I mean, are they interested in the affairs of the company? So that's a question. Management's philosophy and operating style. Like I said, if CEO is coming late, everyone's going to come late. So, and then, you're going to have it to be a norm. Organizational structure. Yesterday we talked about it a little in more detail. So what type of organization is it in terms of whether it is divided on the basis of geography or on products, or it's a matrix structure? What's the span of control and everything, right? So this is the organizational structure we are talking about. Then we have assignment uh, of authority and responsibility. So when you are giving someone an authority, they have responsibility, right? Authority is the power, responsibility is your inner voice, that how much committed you are towards completing your job. And then you have the accountability as well. Okay. So how much importance is given to authority, responsibility, and accountability? And then your HR policies, like how your HR is treating the employees and everything. Okay. All right. Let's keep it till here. So tomorrow we are going to start from 2.2 risk assessment process. Okay. I'm going to send you guys these notes. Just give me a second. All right. So I'll upload it in the group and I think you can download from there. Okay. So bye-bye. See you tomorrow. Bye-bye.